My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'd be able to make friends. I'm just trying to make a little money. My job, not just to entertain you, but to educate, teach. Call me at 1-800-743-CNBC. Tweet me at Jim Cramer. The rap against this market's ironclad. We're headed for a Fed-mandated slowdown that will cause the earnings estimates to tumble. And because the earnings estimates are the #1 driver of stocks performance, that means the averages have to plummet no matter what. So then why are stocks rallying furiously? Dow gaining another 254 points, say S&P advancing 1.19%, NASDAQ pole vaulting 2.01%. Holy cow, those are big and for many unexpected gains.
House of pleasure.
In truth, there are a whole bunch of reasons. Let's start with the macro, the overarching determinant for tons of institutional investors, often because they run too much money to care about individual stocks. They just trade the S&P 500, the index, they go back and forth and back and forth. Because only the baskets are large enough to handle all their capital. While it's true that there's an earnings slowdown, I'm not getting away from that in some areas. If you can get a sense of when the Federal Reserve will stop tightening, you might be able to temper that negativity. Sure enough, right on time, we got an article in the Wall Street Journal this weekend by an authoritative source who says the Fed may do a quarter-point rate hike next week, then 2 more before a pause. Investors are actually hopeful for just 1 additional hike after next week's meeting. Either way, you know what? There's light at the end of the rate tightening cycle. Hey, if that's the case, if the Fed is being more measured going forward, then people will be far less likely to sell stocks, even if the underlying companies report disappointing earnings. No, a slower rate hike schedule doesn't immunize any of your stocks against a slowdown. I don't want you to believe that. It just makes us more optimistic that by the second half, we might see some daylight in the earnings estimates. Some large buyers want to get ahead of the Fed's potential pivot to the end of the tightening cycle. That always happens. Or at least the beginning of the end of the tightening cycle. I've seen it in my 40 years over and over again. People jump the gun. Now, that was a big driver of today's buying and explains some of the bullish backdrop. But let's get to the nitty-gritty of what I see happening, because beyond the Fed, because there's no Fed meeting until next week. And for now, well, let's just say starting tomorrow, earnings are going to be front and center and be furious. So far, we've seen 6 ways otherwise dead in the water stocks have been able to jump higher. And I'm going to run through these 6 ways right now. Let's start with the first one, layoffs. Now, we have seen layoffs give a pop to every company that's restructured, although here we're talking about layoffs that are large enough to move the earnings per share needle. Witnessed the incredible run in Wayfair over the last couple of days. More on that one later. It's so gigantic. In terms of large companies, we've seen Meta Platforms, Alphabet, Microsoft, and Salesforce all jump on the news of mass layoffs. In the case of Salesforce, they fired 10% of their staff, but 4 activists who own the thing right now. Well, they say it's not enough, including the hard-nosed Elliott Management, which owns billions of dollars worth of shares. Of course, the activists aren't just concerned about the headcount. There are accountability issues, too, that they see, including a board shakeup and maybe a new succession plan. But it all starts with the fact that Salesforce hired too many people during the pandemic, something, by the way, even CEO Mark Benioff will admit to you. That said, the fact that so many activist funds are circling a big enterprise software company, one of the most hated areas of the market, is something very new and very positive. The guys at Elliott are incredibly smart. Even though they want major changes, the fact that they're willing to buy something like an enterprise software company such as Salesforce at all is quite an endorsement of the company and its amazing suite of products. Plus, if the company gives the activists the cost cuts they want, the earnings should get a powerful boost. Wall Street always loves those self-help stories. Hey, look, by the way, it's not just tech. Newell, the old Newell Rubbermaid, has been down on its luck, but its stock popped 6% today on a restructuring, too, so let's not limit it. Second thing propelling stocks higher, both the dollar and interest rates peaked last fall. Since then, the most economically sensitive stocks, the cyclicals, which you know I like, have been rallying hard. I don't think they'll have horrendous earnings because many of them do a lot of business overseas. So the numbers will be boosted by that weaker dollar. Many other stocks have rallied since bond yields peaked. Honestly, that might be more important than the short-term rate set by the Fed for these companies. Third potential earnings driver, everybody's worried that relentless rate hikes will cause people to default on their debts, causing real damage to the banks. But if the Fed's nearly done, then those bad loans worries, let's take them off the table. And that's what the market did today. Took all these stocks up. Meanwhile, the rate hikes have given banks a windfall because they can take your deposits, make more money by reinvesting them in short-term treasuries risk-free. Although, no free lunch here, your deposit is beginning to get a higher return. Fourth, the reopening of China. Now, this has so many people excited. You think all the geopolitical tensions with China vanished overnight. Hardly. COVID's now burning through the most populous nation in the world now. We know there are ways to deal with the virus, but it's like the Chinese government has just given up. They want the economy back, and they want it back now. And it looks like they're getting a wish. Right now, it's the Lunar New Year. And so far, it looks like a strong one for consumer spending. Oh, that's good for Macau casinos, travel in general, and U.S. companies that do big business in the PRC, like Nike, like Starbucks, and Estee Lauder, which we own for the Charitable Trust precisely because of the grand reopening. We own Wynn, too, and talk about those both. We talk about them, all of them, our morning meeting at 10:20 and our new home stretch afternoon broadcast that appears around 2:30 p.m. China's pulling off a gigantic shift. China's used to be so important, then COVID hit and pretty much went away. Well, now China's back. Fifth, we're beginning to see the fruits of all the infrastructure spending Congress authorized in the past couple of years. Most states are still nowhere near authorizing these projects, but the money's there whether the Fed tightens or not. Consider it a safety net for any company remotely connected to the building of roads, bridges, tunnels, or even large buildings. That means you can buy Nucor or Cramer Caterpillar, or even the rails as they start to report tomorrow. Sure, they can go down, but they won't be able to stay down. That's what matters, because we know all the spending is on the horizon. Sixth, and perhaps most important for a day where semiconductors went nuts, it looks like analysts are trying to get ahead of the end of this gigantic inventory correction. Remember the glut I keep talking about by recommending stocks like AMD? Did you see that today? Qualcomm? Wow. NVIDIA. And it's working as they all soared. Remember, the inventory glut included everything from cell phones to desktops to high-performance computers. This is a very big deal, people. Very big. The Deutsche Bank analysts who recommended these semiconductor stocks acknowledged that it's a 2024 story. I get that. For example, now I can see Micron benefiting from the cutbacks it made last year because they initially helped create the glut and now they're alleviating. Now, a special thing here. I want you to pay special attention to NVIDIA, NVDA, because it, of course, turns out to make the platform for the ChatGPT program you keep hearing so much about. Remember when I told you that you might be able to tell an AI to make me a painting like Cezanne, or have a real conversation with it? You could even have it talk to you as yourself. I saw that with my own eyes at NVIDIA's headquarters. A friend of mine, this thing's just exploding. A friend of mine, a CEO, shared a ChatGPT-generated haiku about this coming showdown this Sunday between the Eagles and the Niners, but I will not share it because he is, alas, from San Francisco. Well, it's here. That's right. And this whole idea of the semiconductor as a way to be able to create in your head and then present without having you do anything, well, it's here, no matter who uses it. Citi says AI, this is why I really want to mention Citi says it's a $5 billion opportunity, but an outside chance of $11 billion. You heard me, $11 billion with this chat. This thing could be real. Here's the bottom line. With those 6 positives countering the expected earnings downturn, you have to expect the market to be a lot more sanguine. At the moment of the first print, when we see the numbers, I still expect to see some vicious declines. The difference from 2022, those declines, they might be buyable. Matt in Wisconsin. Matt.
Jimmy, what a matchup for the championship next week.
It is going to be the real deal, but my feeling, I feel about the birds. What's happening?
Well, so one theme you've been talking about recently, especially after the J.B. Hunt call last week, is the normalization of inventory management challenges. And so how do you think that sets up for Levi's as they come on and report this week? Because they've been dealing with a lot of oversupplied inventory like a lot of the apparel industry.
Matt, this is a brilliant question, and I thought the same as you did, that it was time. However, Matt Boss at J.P. Morgan downgraded the stock today, and I cannot go against Matt Boss. He is too good. Betsy in California. Betsy.
Well, hey, Jim, how you doing?
I'm doing fine. How about you, Betsy?
Can I tell you something? I learned so much from the monthly meeting, and anybody who doesn't become a member and doesn't listen to that is missing out. And I will tell you what I learned from it. I'll tell you what I learned from it, Jim. I did more research on Estee Lauder after the call. And what I found was there were 12,000 flights canceled. Okay? If there were 12,000 flights canceled, there were over 1 million people stuck in the airports. And they didn't have their suitcases, and they didn't have their Clinique and Smashbox and Bumble and Bumble and the Lab Series and the Bobbi Brown Cosmetics. And where did they go? They couldn't go to a mall. They were waiting for the plane to be coming in. So Estee Lauder probably made out like a bandit at the airports.
Oh, my, Betsy, that is one brilliant analysis. I have to admit, I hadn't thought of it. Their duty-free is exactly their most important venue other than China. You know, on the home stretch today, right around 2:30, Jeff Marks and I talked about Estee Lauder. I wish I had your horse sense. I would have thrown it in as one more reason why this stock, up 36% in the last few months, has much more to go. Thank you. Thank you for those kind words about the club. With the 6 positives countering the expected earnings downturn, you have to expect the market to be a lot more sanguine, don't you? And it is on Mad Money tonight. Wayfair caught 2 back-to-back rallies, up nearly 50% in 2 days. So what has Wall Street rallying around the stock? I'm digging into the recent headlines. Then Bitcoin bouncing back. So is it time to take a close look at the crypto cohort, or is this market giving you a better way to hedge against economic uncertainty? I'm going off the charts to find out. And get this, Eli Lilly announced last week that the FDA shot down the company's request to fast-track their Alzheimer's treatment. So what material impact, if at all, could this news have on the stock? I'm going to give you my take. And it's pretty darn disruptive. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.